Some of you stack physical silver and gold. Some of you stack paper shares. Some of you do a little bit of a mixture of both. I'm more of a mixture of, having a bunch of different assets. Now, this is for you guys who, let's say, for example, you got some, S&P 500, you got some miners, you got some commodities, indexes, so on and so forth in a portfolio. And you say, I don't really want to draw this down in retirement. Well, do I have an opportunity for you to consider? Now, this isn't financial advice, but I want you to use this video as a springboard to do your own research on a portfolio line of credit, also known as a PLOC, which is essentially a collateralized loan against select investments from your portfolio. Now, for those of you who aren't aware of this, I'm going to give you an example later on this video. It's a very rough example of how this might play out for somebody in retirement. And I want to show you this because I think a lot of people within this country think there's only one way to kind of do retirement, and that's pretty much the 401k, where you basically have, an annuity that you have paid into, and you are going to be distributed in a certain amount to the point where your nest egg will eventually run out. This is essentially a way for you to kind of slow the tide of those funds running out, or hopefully not have it run out completely by the time you pass. Now, if you are skeptical about this, the SEC has actually written about this back in 2015, securities-backed lines of credit. And basically, for those of you who are curious about it, it's not uncommon for a firm to require that your assets have a market value of $100,000 or more to qualify for one of these lines of credit. So obviously, this is for somebody who has a decent amount of cash. This is not for somebody who has, let's say, $1,000 in a brokerage account, though those people can use things like margin. But this is specifically for things not involving buying additional shares of a stock. Now, you may want to know, how much can I borrow? Well, typical advance rates range from 50 to 65% for equities, 65 to 80% for corporate bonds, and 95% for U.S. Treasuries. For example, if your account contains a mix of equities, securities, and mutual fund shares with a total market value of $500,000, you could be eligible to borrow from $250,000 to $325,000 for an SBLOC. Now, you may start to wonder, well, who uses this? Well, obviously, with people who have $100,000 worth of value, it's people who tend to have a lot of money. And one of the advantages of this is you don't have to pay taxes on debt. So if you have a large amount of money and you are worried about paying capital gains from having to sell your shares in order to realize cash, this is another way for you to access the value of your portfolio without having to sell shares and pay double-digit percentages on that. And you might just have to pay a single-digit percentage, though it is variable, which is essentially the level of interest, the interest rate that generally comes with this. Now, we'll talk about a little bit about that soon. But here's the thing. Here's the long and short of it. SBLOCs generally allow you to borrow as little as $100,000 and up to $5 million, depending on the value of your investments. So you do have to borrow a large amount to start, to start out with this. And we'll go into that in our example. Generally, interest rates compound daily. So you might have, let's say, for example, a 7% annual interest rate. That means you need to solve the effective annual interest rate, which would be a little bit more than that 7%. It wouldn't be a league amount of more. It's just you're compounding daily as opposed to compounding annually or compounding monthly. So with that, you'd also tend to get billed monthly. So that's also something to take note of. So now that we have the long and short of it, of what this entails, let's take a look at our example on the spreadsheet. Again, this is a rough example, but let's say you're a person who makes a decent amount of money, let's say about 60,000, 70,000, 80,000 US dollars, doesn't have many expenses. And let's say you also have a spouse who does the same thing. And and you don't have a 401k, but you have this brokerage account and you decide to put your money in this because you say, well, hey, on the low end, I might make about 8% average annual return. Now you might wonder, well, how do I get that? Well, this is for a very safe portfolio. So average annual return of the S&P 500, which tends to be the benchmark for a lot of returns, is about 10% since the 1920s. Now, in the last 10 years, it's about 13.6%. In the last 50 years, it's about 10.9. In the last 30 years, it's about 9.87. I've seen basically ranges on the low end being about 8%, being up to about 12%. So I decided to make this very hard on ourselves and give us just 8% over a 25-year period. And you basically are investing monthly. So your investments are compounding monthly. So this is essentially an ordinary annuity problem. And basically after 25 years, you get close to about $2 million from doing this monthly. You heard that right. By not selling, putting $2,000 into something that only gives you an 8% return after 25 years, doing this monthly, without stopping, you'll get about $2 million or close to it. So let's say, okay, I'm ready to retire and you want to do a securities-based loan. So you have about $1.9 million to play with. And your idea is that, well, my loan will continue to, or the value of my stocks will continue to grow, though I do need to draw a line of credit based on my living expenses. And from the information we gathered from the SEC, that means that you need to have at least $100,000 that you draw. So that's about 0.053% of this. Perfect. Now, why is that perfect? Well, this can always drop significantly, especially if it's, hedged to the market. And we'll talk about that in this example here, as far as the 50% market crash. We'll have that in our example. So you pay, let's say, about 7% on this annual loan. Now, I did not do an effective annual rate here, which would probably be a little bit more than what this is, but not too much more. You have to pay this monthly. I didn't count that in here either. So annually, this is what you would have to, this is what you'd be on the foot for, or this is the bill you have to foot. Now, let's say, for example, you pay this off in a year and eventually you pay this back in your repayment. But let's say you actually use this for the next 4 years. That's basically roughly around $25,000 a year in living expenses. And of course, your wife might have, let's say she has her 401k account and you have this. And, for yourself, it's about $25,000 a year to live. And that actually might be overkill, especially if you are no longer paying rent, or let's say if you are no longer paying a mortgage and you paid off your home. So let's go over here. This is the balance that will grow for the full year after you draw these expenses. Again, this is very rough. End of year balance, assuming an 8% growth rate and factoring in the loan that you have to pay, you actually wind up with a little bit more than what you started out with. And this is what you made. And this is essentially the difference within that year. So you actually made a little bit more money that year. So over the course of the next 4 years that you're no longer drawing from or creating some debt, you're actually making money. Take a look at this. End of balance of retirement year one, 1.9, 1.98, 2.14, 2.312, and then boom, market crash. So with a market crash of 50%, this is again pretty excessive, but this is essentially what we saw in 2008. We are now down to 1.2 for the value of, or I'm sorry, 1.2, because this is going to happen in the middle of the year. You actually have to draw another 100,000. Again, I'm trying to do very extreme examples here. You have to draw another 100,000, about 7% on that again. And then in the middle of that, you have a 50% market crash. So now you're down to 1,207,000. So things are looking a little rough and dicey, but still over the course of the next several years, the value of your portfolio goes up. So again, this is something that will slow the tide a bit of you losing the value of your overall portfolio due to capital gains and just essentially due to capital gains, though you will have to pay interest on debt. So guys, let me know what you think about this as far as your portfolio. This is a very, very rough example again, but let me know what you think in the comment section below.